Section 5. The Future of Monetary Policy Frameworks. Continuing the discussion of Ben Bernanke's recommendations to the Bank of England to adopt a scenarios-based approach to monetary policy and more. The previous section illustrates the macroeconomic implications of a lack of credibility as defined in the model. However, the reason why the ECB lacked credibility requires a broader discussion about analytical frameworks. In this section, we will discuss some of the pitfalls made by the ECB, while also outlining a series of basic steps we recommend for structuring the adoption of a risk management approach to monetary policy. Step 1. Establish a clear inflation target. Step 2. Publish the path of the policy and exchange rate that is considered consistent with achieving the inflation target. Step 3. Adopt a plausible scenarios-based approach to monetary policy. Step 4. Adopt a full-fledged risk management approach to monetary policy that emphasizes avoiding dark corners. Step 1. Establish a well-defined target. Prior to the pandemic, the ECB's inflation objective was unclear and communicated as an inflation rate below but close to 2%. However, that issue has been addressed in the ECB's 2021 strategy review by stating unambiguously that the inflation target is 2% and symmetric. Removing the ambiguity has removed a lot of the perceived tolerance of the ECB to inflation expectations ratcheting downwards exemplified during the early onset of the pandemic. Step 2. Publish the path of the policy and exchange rate that is considered consistent with achieving the inflation target. Once a central bank has established an inflation target, it becomes critical that the central bank is able to communicate a policy outlook that is consistent with its stated objectives. Publishing an endogenous interest rate and exchange rate serves this purpose. While the ECB surely has models that produce an endogenous interest rate and exchange rate path, they do not publish this path in its macroeconomic forecasts. Instead, the ECB presents an output and inflation forecast using exogenous interest rate and exchange rate assumptions. Therefore, they omit the story of monetary policy and a critical part of the transmission mechanism from its policy communications. Step 3. Adopt a plausible scenarios-based approach to monetary policy, the same recommendation by Ben Bernanke in his review of the BOE. However, Bernanke did not go into much detail about what exactly a scenarios-based approach would look like in practice. That said, before describing our approach, we find it important to express the pitfalls of moving to this step without first having established steps 1 and 2. Returning to the pandemic period, the ECB exemplified this pitfall when it produced multiple scenarios in June 2020 based on different assumptions related to the severity of the COVID-19 pandemic, Figure 11. At the time, the ECB did not have a clearly defined target, and its projections for inflation and unemployment were accompanied by an exogenous interest rate and exchange rate assumption. Therefore, the projections lack purpose when the objective is unclear and lacks consistency when the monetary policy transmission mechanism is absent. Furthermore, the serious problem presented in these scenarios is that inflation never returns to a target. The ECB presents 4 scenarios where inflation settles at 1.7%, 1.6%, 1.3%, and 0.9% after 3 years in each of them. This type of scenarios-based approach, while addresses uncertainty, would still invite attacks on its credibility. By publishing these scenarios, the ECB essentially gave its stamp of approval for inflation expectations to wander downward, as evident in the June 2020 experience and illustrated in the simulation exercise in Section 4. As for how to implement a scenarios-based approach, the CBA has chosen a structure where the analytical process begins by defining a market reference scenario. After all, it should be the central bank's main communication objective to nudge financial markets in a particular direction when necessary. Therefore, it seems logical that a communication strategy to achieve this begins by recognizing what is currently priced in financial markets, which we refer to as a market reference scenario. It is more difficult to derive a market reference scenario in emerging markets like Armenia, where they currently conduct a survey of commercial bank expectations of the policy path. Since the US and Euro area have deep financial markets and professional forecasters to derive a richer market-based macroeconomic outlook with all the relevant variables, interest rates, GDP, inflation, unemployment, etc. In any case, after constructing the market reference scenario, the central bank staff then asks whether the reference scenario makes sense or not and develops a narrative through the prism of the 3 questions. Then, with the market reference scenario and narrative in hand, the CBA conducts an adversarial collaborative case study approach where they derive two plausible scenarios that would require a policy rate path that is above, case A, or below, case B, the market reference scenario. The scenarios are chosen by the chief economist but are meant to incorporate the most pertinent issues that the policymakers are concerned about at the time. Of course, this requires some collaboration between the staff and the policymakers during the projection process, but ultimately the scenarios would be owned by the staff, and policymakers should not feel tied to these projections when they express their personal views. The scenarios simply serve as an illustration that makes a strong case for why the most likely scenario is a case A versus case B path. And perhaps more importantly, it acts as a frame of reference for policymakers to describe their own views. Are they more aligned with case A type scenarios or case B type scenarios? This is one way the framework attempts to address communication issues related to the cacophony of voices commenting on monetary policy. The scenarios provide structure for discussing the range of views that will always exist rather than pursuing futile attempts to achieve consensus. This setup mirrors how Alan Greenspan described his approach in his 2003 Jackson Hole speech on monetary policy under uncertainty. A policy action calculated to be optimal based on a simulation of one particular model may not, in fact, be optimal once the full extent of uncertainty is taken into account. It is entirely possible that different policies will exhibit different degrees of robustness with respect to the true underlying structure of the economy. For example, policy A might be judged as best conditional on a particular model of the economy, but might also be seen as having relatively severe adverse consequences if the true structure of the economy turns out to be other than the one assumed. On the other hand, policy B might be somewhat less effective in advancing the policy objectives under the assumed baseline model, but might be relatively benign in the event that the structure of the economy turns out to differ from the baseline. Greenspan, 2003. Obviously, the staff cannot incorporate all risks into two scenarios and should augment the analysis with an exhaustive list of risks with a qualitative assessment of their policy implications. So far, these two scenarios can be generally regarded as scenarios that work within a linear framework where macroeconomic forces are not getting too out of hand. That is, we are in the linear part of the Phillips curve and the linear part of the monetary policy loss function, where deviations of inflation from target and output from potential are between -1 and 1. However, as the COVID-19 pandemic showed, when uncertainty is heightened and there are reasonable fears of entering a dark corner of monetary policy, then it has become apparent that central banks must, step 4, adopt a risk management approach to monetary policy that emphasizes avoiding dark corners or policies of least regret. The priority for the next generation of monetary policy frameworks should be to formalize the risk management approach to monetary policy that brings nonlinear implications embedded in models such as Endogenous to the forefront of regular policy analysis. This takes the plausible scenarios-based approach one step further. Given our inevitably incomplete knowledge about key structural aspects of our ever-changing economy and the sometimes asymmetric costs or benefits of particular outcomes, a central bank seeking to maximize its probability of achieving its goals is driven to a risk management approach to policy. By this I mean that policymakers need to consider not only the most likely future path for the economy, but also the distribution of possible outcomes about that path. They then need to reach a judgment about the probabilities, costs, and benefits of the various possible outcomes under alternative choices for policy. Greenspan, 2003. Here, Endogenous provides important insights for conducting this type of analysis. For instance, experimenting with the convex Phillips curve and uncertainty around the NAIRU can illustrate the costs and benefits of alternative policy choices as described in DeBell and Laxton, 1997. Furthermore, a nice feature of the model is the quadratic loss function that imbues monetary policy with a perspective for when it becomes natural to switch from a linear to a nonlinear response. When the deviation of inflation from the target or output from potential is between -1 and 1, the response is roughly linear. The moment these gaps exceed -1 or 1, then it is a signal for policymakers to get aggressive with their policy strategy to lower the risk of entering a dark corner or a policy of least regrets. Coined by the Reserve Bank of New Zealand, a policy of least regrets described their policy strategy during the initial phases of the pandemic to explain the mix of ultra-easy monetary and expansionary fiscal policies. Hawkesby, 2021. Such policies, if successful, were communicated at the time to have inflationary consequences, but the ex-ante risk was considered acceptable given the uncertainty around the collapse in demand caused by the lockdowns. These types of scenarios within the FPS Mark II framework are referred to as Case X scenarios, and again follows Greenspan's risk management vision. At times, policy practitioners operating under a risk management paradigm may be led to undertake actions intended to provide some insurance against the emergence of especially adverse outcomes. Greenspan 2003. To summarize, a full-fledged risk management approach to monetary policy begins with a well-defined inflation objective accompanied by macroeconomic projections with an endogenous interest rate and exchange rate that steer inflation back to the target. This experience and structure allows central banks the freedom to investigate uncertainty without thinking it will threaten its credibility, since the endogenous policy in the model ensures all scenarios credibly return inflation back to the target. There are two layers of uncertainty analysis: linear, highly plausible scenarios represented by Case A and B scenarios, and nonlinear dark corner scenarios represented by Case X scenarios. In the next section, we conduct a projection exercise to illustrate this type of framework in practice and how a central bank would potentially use a Case X scenario to lay the foundation of a policy of least regrets today. All these components capture the key insights from Alan Greenspan's view of what a risk management approach to monetary policy means in practice. However, while Greenspan was purposefully opaque in his communication strategy, we have left that paradigm behind and have moved towards greater levels of transparency. And based on the structure we have laid out, there is no reason that a central bank cannot do this type of uncertainty analysis and communication in a transparent way. It simply requires experience, discipline, and trust that being honest with the public and financial markets is the best path forward to build credibility and produce better policy and macroeconomic outcomes in the process.